Will 2024 be another slow year for housing? And could we see the Fed lower interest rates sooner rather than later? Yahoo Finance spoke with experts and analysts to discuss the latest economic data and what it all means.
Let's kick it off with our top story of the day. The December jobs report coming in hotter than expected on the headline number. The U.S. adding 216,000 jobs during the month of December. Now, it is the first of a slew of data that the Fed is going to be getting before their first meeting of the year. Here to break all of this down and what this report could mean for the Fed's next decision, we want to bring in Yahoo Finance's Jennifer Schomburger. Jen.
Good morning, Shauna. First jobs report since the Fed signaled it has finished raising rates and could soon cut rates sometime this year. But the December jobs report coming in much stronger than expected on all metrics, whether it was that top line non-farm payroll number, wage growth, or the drop in the labor force participation rate, all likely to take the possibility of a rate cut that Wall Street has priced in for March off the table. And indeed, if you look at the CME futures, those bets are being dialed back this morning. The job market, based on this morning's data, still too hot for the Fed's taste. They would really need to see job growth in the area of 100,000 or less on non-farm payroll numbers per month, and wage growth closer to 3% rather than the 4% that we've been getting for them to consider cutting rates. Now, if we do look at the revisions, I want to point out a trend that we've been seeing, which is that the job reports keep coming in very strong initially, but then they are revised lower subsequently. And you saw that in the months of October and November in this very report. October was revised down to 105,000, while November was revised down to 175,000. So collectively, 71,000 fewer jobs for those 2 months combined, showing that perhaps the job market is coming into a bit of a better balance and cooling than what we saw on the top line number this morning. Still, taken together, there is nothing in this morning's jobs report or the latest jobs data that indicates that the Fed is going to cut rates anytime soon. And frankly, guys, if we continue to see such strong job reports month after month, you gotta wonder if they're gonna consider hiking again. Guys?
All right, Yahoo Finance's Jennifer Schomburger, always keeping us on our toes. Possibility of additional rate hikes in 2024.
Big story of the day, the December jobs report coming in hotter than expected, with growth in government, healthcare, and social assistance construction leading the way. So how is this translating to employee sentiment? Well, for that, we want to bring in Daniel Zhao. He's Glassdoor's lead economist. Daniel, it's great to have you here on set with us. Let's talk about the numbers that we saw in this jobs report. Yes, that headline number was strong, but there were certainly some data points to be a bit concerned about. Labor force participation slipping just a bit. How does this compare to what you're seeing on your platform?
Well, yes, I do think that the jobs report is actually a little bit of a mixed bag under the hood. We saw payroll growth was very strong, but labor force participation came down a little bit. Employment from the household survey came down a little bit. On the flip side, we are seeing on our platform that employee sentiment is starting to pick up. It's increased for the third straight month in December. It's still down significantly compared to where it was a year ago, but hopefully that gives us a little bit of optimism heading into the new year, that employees are feeling a little bit more comfortable about their job security and the risks of a recession in the new year.
And I guess maybe just take a step back. How do you guys kind of calculate that employee confidence? And then maybe when you look as an economist at just kind of the setup of the headline numbers from the labor market, how does that, what is that employee confidence indicating relative to kind of those more mainstream data sets, let's call them?
Yes. So employee confidence, we basically just ask employees how confident they're feeling about the business outlook for their employers over the next 6 months. And then we do some calculations. We make sure
differential, good versus bad kind of thing?
Yeah, essentially, right. And so when we look at that data, really what we want to get a sense of is there's these business confidence measures, consumer confidence measures, but how are employees feeling? Because they have a pretty good pulse on how businesses are actually doing. And when we look at that data, we think that it signals a few different things. It signals how those businesses might be doing financially, for example, but it also might tie into other labor market indicators like the quits rate. Because if you're feeling particularly good about your employer, well, you might not want to quit. And conversely, if you feel really good about the economy, but not so good about your employer, you might decide to quit to look for a better opportunity.
Dana, when we talk about who has the upper hand right now, we talked for so long that it was the employees throughout the pandemic, given the fact of the situation that we were in. Has that now reversed? And I guess in terms of that smaller headcount that we've heard so many business leaders talk about over the last several quarters when they talk about more reliance on efficiency, looking to streamline their business, what impact then does that have to the employee?
Mm-hmm. Well, I don't think it's fully reversed. I think that the labor market is still fairly hot, but it's definitely more on a case-by-case basis now, right? So this isn't 2021, 2022 where you could throw a stone and find a job opening, right? So
for a 20% raise.
Right. So for now, it's a little bit more. Job seekers have to do a little bit more research to find those industries or those parts of the industries that are still hiring, that are still looking for workers, and you probably aren't getting quite the same raise that you would get just a few years ago. But at the same time, this is still a fairly strong labor market. Unemployment is still low. There are still those opportunities out there. It's just a little bit more selective.
I'm curious how you think about, again, working at a firm like Glassdoor, and we see, LinkedIn has an economist team, Indeed. How you think about the JOLTS report in the context of the work that you guys all do, looking at your own platforms, because there's, it doesn't come up too often, but every so often there's like, well, are we sure we know how many jobs are really open, all this kind of stuff? I'm just curious how you think through that, the way the BLS adjusts it, what you guys see on your platform, and what that data set's been telling us about the labor market.
Well, the BLS does absolutely fantastic work. They are really the gold standard in understanding what's going on in the labor market, and we like to think of ourselves as providing supplementary data, right? Like we can provide a view into maybe how employees are feeling, or maybe some of the things that they're talking about in their reviews that you can't really get from just like a plain old survey, right? And so we're hoping that can provide a little bit of additional context to those BLS numbers, but we're definitely not trying to replace them or anything.
Dana, what are you seeing just from a skills shortage standpoint? That was a story that we had talked about for so long, kind of getting buried at this point.
Throwback.
With
2017
but I bring this up though just because of the productivity issues, or I should say concerns going into it with the development of AI, exactly what impact that's going to have on the workforce. Is that further exacerbating maybe the shortage that we had going back a couple of years?
I think the skills shortage narrative tends to be a little bit overblown in the sense that a lot of people underestimate how transferable their skills are. And certainly as we're talking about kind of what skills are going to be important in the future, I think soft skills are still going to be extremely important. It's not just about having a STEM degree nowadays. Those soft skills will still be important, that person-to-person interaction. I don't think that AI is really going to fully replace. So I think that those are skills that are applicable across industries. And even those hard skills too, I think a lot of people say oh, tech is going through this slowdown, but those tech skills are just as valuable in healthcare or in finance or in other industries where hiring might be a little bit more stable.
Another win for the liberal arts. We love to see
Huge
it.
Win.
Love to see it on this program. All right, Daniel Zhao, Glassdoor's lead economist. Thanks so much for stopping by.
Thanks.
They command multi-billion-dollar empires and dominate the boardroom.
I admit when I'm wrong.
What you want to do is control your controllables.
Decisions that impact your investments are made by them every single day.
Profit and purpose go hand in hand.
Now, Yahoo Finance grants you exclusive access to these titans of industry. Discover the motivations behind industry-altering decisions and the visionaries who imprint their legacy on the world's most renowned companies. Join us for our groundbreaking series, Lead This Way.
Here in Washington at the Labor Department, where this morning's jobs report came in much stronger than expected. 216,000 on that top line non-farm payroll number, with the unemployment rate holding steady at 3.7% and wage growth coming in stronger than expected at 4.1%. For more insight on this morning's jobs report, I want to welcome into the program Acting Labor Secretary Sue. Secretary Sue, thank you so much for joining me. Happy New Year.
Good to see you again. Happy New Year, Jennifer.
Good to see you. Interest rates at a 23-year high, and yet the job market continuing to surprise to the upside, yet the labor force participation rate dropped. Why was that, do you think?
Right. So these are December numbers. So let's just take a moment to recognize what happened in 2023, right? The 216,000 jobs created in December were part of a monthly average over the year of 225,000. At the same time, as you noted, unemployment remained under 4% for 23 months straight, almost 2 years, really defying all expectation. We also saw throughout the year labor force participation rate come roaring back, right? Roaring back after the pandemic. We saw it. We've talked about this here about women, right, coming back into the labor force, it reflecting both like confidence and a desire to work and ability to find jobs. And those were all part of the Bidenomics approach to an economy in which we can build the economy back through good jobs by investing in America. We can do right by workers by making sure that there's enough breathing room, right, enough wages to live on, and we don't have to have those things, you know, by sacrificing worker well-being. And so all of those things, I think, it's that coveted soft landing that many people predicted would not be possible. And so we look back on the year and say, you know, policies worked. They didn't happen by accident, and we've got more work to do in 2024 to keep it up.
But why do you think the labor force participation rate fell back?
So I think there was a tick down in December after, again, these historic highs that have come back in, right? But not in any way that's concerning. You know, these overall throughout the year and also in December, right? The overall numbers are reflective of strong and stable growth. And of course, we have more work to do. Of course, we want to make sure that everybody who wants to work can get a job and get a good job that offers them economic security, right? Dignity, you know, a job in their community so they don't have to commute really far to do it. All of those are part of our vision for 2024, building on the successes of 2023.
So then how does this forebode for the job market outlook for 2024?
So 2023 was a big year for working people. Right? Big gains at the bargaining table, right? Higher wages, as you noted, you know, more retirement security, stronger health and safety protections. You know, we saw job growth across multiple sectors, right? So government was strong this past month, but leisure and hospitality has been up, construction has been up. There's been over 800,000 manufacturing jobs created since President Biden took office, and most of the investments that he's helped to make possible are still just hitting the street. So 2024, you know, we say, you know, is going to be our best year yet because policies matter, leadership matters, and we're going to be building on the strength that we have seen month over month in 2023.
Fed Chair Powell said in December during his press conference that he thinks that the era of frantic job shortages are behind us and that we're seeing job openings come back to a more normalized level. Do you agree with that? Or do you think there's more that needs to be done for the job market to come back into balance?
I think the idea of things normalizing is a good way to paint what is happening. But they're also normalizing in a way that President Biden said was possible and many people thought was not, which is record job growth, right? We're 14.2 million jobs created, combined with record low levels of strong, sustained unemployment, combined with wage growth, right? All of these things, and currently, right, wage growth that is outpacing inflation so that workers really feel it in their pocketbooks. Families can feel some more, some more financial security. So yeah, this is the, you know, Bidenomics in action, right? It's the idea that we can build that kind of economy. We've seen it happen over, you know, a incredible recovery since President Biden came into office. And looking over at 2023, I think it, you know, the numbers answer the question. And we want to continue that steady, stable growth in jobs at not the breakneck speed that we saw in 2022, but more at the pace that we saw throughout 2023.
Switching gears, I want to ask you about artificial intelligence, because there are a lot of concerns about this in Washington, about hiring biases being institutionalized, job killing. The Labor Department recently held a forum back in December on the pros and cons of AI. What did you learn, and how is the Labor Department prepared to ensure that AI can help actually boost the job market?
Right. So we confirmed a few things that we thought, right? One of which is that there is nothing inevitable about what AI is going to do. Everything we do are policy choices that we have a chance to make right now, and we want to make in conjunction with industry, right? You know, across government. The president's executive order is about a whole of government approach to making sure that we harness the benefits of AI and really make sure that we curb and limit any of the harms, right? And some of those harms, as you noted, are algorithmic bias in the adoption of AI. AI is only as good as the people who build it, and we live in a society that still has bias. We don't want that to be the future of AI. Job displacement, right? There's nothing inevitable about that. People have been talking about a robot apocalypse every time there's evolution in technology, and those are choices we can make. And what we've seen also throughout 2023 is that when workers have a seat at the table, when they have a voice in helping to figure out how will AI be deployed, how will AI be used, how can AI be used to improve workers' lives rather than to hurt it, it makes a difference. The Writers Guild, SAG-AFTRA, right? They bargained over it and found ways to protect their jobs and the future of their industries when it comes to AI. I was just with the vice president in Las Vegas. We were meeting with culinary workers who bargained around how AI will be used and how much information they get about the adoption of AI and how they're going to be a part of designing that future in their industry. So we think that AI has the potential to do good things and the potential to do bad, and which one we choose, is very much a choice.
And then before I let you go, I do want to ask you about women, the workforce, in childcare. So I have in my notes here, according to Bank of America, the average child care payment per household has risen 30% since 2019, with middle and upper income families, these are families that are earning $100,000 to $250,000 a year, seeing the biggest increase. And the investment bank says this is driving parents out of the workforce. We actually see fewer dual income households now than we did in 2019. So what is the administration prepared to do about this to boost participation in the workforce?
It's such an important question. This is why President Biden has said from day one, we have to make sure that we build our child care infrastructure along with all of our physical infrastructure, right? This is something that dramatically affected labor force participation during the pandemic, right? We certainly saw that. But we also know that if we do not address childcare needs, and frankly, this expands beyond childcare, right, to elder care. We have an aging population. So if we don't address those, it is going to have a dramatic impact on the ability of women in particular to participate in the labor force. In fact, the Department of Labor recently put out a study that found that if the United States invested in childcare and other family-friendly policies like paid leave in the way that other comparable developed countries do, if we did that, it would drive economic growth to the tune of billions of dollars. It's a cost of doing nothing report, meaning if we don't do it, it's costing us as a country about $775 billion a year. So, people often talk about the cost of childcare. We also have to think about the cost if we don't do enough. And so that's why we are so focused as an administration on doing everything we can within our power to really build up the childcare infrastructure and to support childcare jobs so that they're also good jobs, because they're also overwhelmingly done by women.
Yeah, I mean, to your point, in that report that you're referring to, the labor force participation rate for women in the largest 15 countries, when we compare the U.S., we're dead last. But we'll have to leave the conversation there. Thank you so much for your insight, as always, Secretary Sue. Look forward to speaking with you next month.
Some weak data on the housing market, mortgage demand dropping over the holidays. This is according to the latest data out from Mortgage Bankers Association. Now, that's even as mortgage rates continuing to fall through the month of December. We did see, though, rates level off just a bit, because just last week, rates ticking just a bit higher. Now, our next guest being a bit more optimistic about the real estate market this year, but encouraged about some of the buying activity that we could see. For more on that, we want to bring in Daryl Fairweather, chief economist with Redfin. Daryl, it's great to have you here. So let's talk about what we're expecting from the Fed, potential rate cuts this year, what exactly that then means for potential home buyers out there. How big of a driver do you see that being for the housing market in 2024?
The recent data from the economy shows that the economy is starting to normalize, which is why the Fed can pull back a bit. And this is great news for the housing market. The recent decline in rates has already encouraged more buyers to come back, and sellers are coming back too. So with more supply and more demand, it just looks like it's going to be a healthier year for the housing market.
So talk to us a little bit more about a healthier year. Than what more specifically should we be expecting?
There will be more buyers and more new listings. It's a little bit too early to say exactly how strong demand or supply will be, but I think we're going to see more sales this year than last year. And it's a bit uncertain if prices are going to go up or down. We're forecasting that they go down just a little bit, but that could change if demand comes back stronger than supply does.
So when we talk about affordability, obviously a massive issue here. We are seeing maybe some improvement when you take into account that mortgage rates, the 30-year mortgage rate off the highs that we saw not too long ago. How do you see that story playing out, given the fact that we would likely see a supply shortage if we do see any improvement on pricing?
The recent decline in rates is improving affordability already, but I think the window for which affordability is going to improve is going to be a short window, potentially only this year, because once buyers come back to the market, they're going to start competing, and that's going to drive up prices unless we see a substantial increase in supply to match that demand. And there's really no place for that increase in supply to come from because we're not seeing as much new construction as we did these past couple of years.
When it comes to that new construction, clearly a lot of potential home buyers, especially new home buyers, really not given another option, given the fact that existing homes simply are not on the market. How big of a player do you see that being in the housing market this year and the ability maybe to alleviate some of the pain that we're seeing for inventory levels?
I think new construction is going to play as big of a role this year as it did last year. We're going to see more existing homeowners decide that now is a good time to move. People who had been previously putting it off because they didn't want to trade their 3% interest rate for a 7% one, some of those people just can't wait any longer. And also the decline in rates is making that decision not so difficult. And new construction has already slowed down. So I think it's going to be more driven by existing stock of housing than new construction this year.
All right, Daryl Fairweather, great to have you here, Redfin's chief economist. Thanks.
Officials believed during their December policy meeting that interest rates were likely at or near the peak for the current rate tightening cycle, and almost all participants felt that rates could end 2024 lower given progress on inflation. Now, even though almost all thought that rates could end the year lower, they stressed there's a lot of uncertainty around that and that the economy could evolve in a way that would cause them to actually increase rates. Many said that an easing in financial conditions beyond what was appropriate could make it more difficult for the Fed to reach their 2% goal. And ahead of these minutes, we saw a lot of divergence in opinions from several Fed officials after Fed Chair Powell made that dovish pivot. And we saw evidence of that in these minutes. Specifically, several said that the economy or inflation might evolve in a way that will require them to hold rates at the current level for longer than expected, while some warned about the risks of being restrictive for too long. Now, one thing that everybody agreed on, clear progress has been made on inflation, but they still needed to see more evidence that inflation is moving back towards their 2% goal. They don't think that there are risks to the upside, but there is a risk that inflation could stall. Now, I do want to point out that Fed officials underscored that they're looking at the 6-month measure on inflation readings. And that's very interesting because if you looked at the most recent read on the Fed's favorite inflation gauge, core PCE, on a 6-month annualized basis, that actually clocked in at 1.9%, so a tenth of a point below the Fed's 2% target. So officials very much paying attention to that metric there. So bottom line here, guys, it does look like rates are moving lower possibly this year, but there's significant uncertainty around that forecast and outlook. It's really going to depend on how the economy evolves.
They command multi-billion-dollar empires and dominate the boardroom.
I admit when I'm wrong.
What you want to do is control your controllables.
Decisions that impact your investments are made by them every single day.
Profit and purpose go hand in hand.
Now, Yahoo Finance grants you exclusive access to these titans of industry. Discover the motivations behind industry-altering decisions and the visionaries who imprint their legacy on the world's most renowned companies. Join us for our groundbreaking series, Lead This Way.